Good morning. Today is Saturday, the 23rd of September, and we've had an exciting week, haven't we, Andy?
Sure did. Last week was everything we had expected and hoped for in terms of market action. And at the same time, really, for two fairly hawkish people, the Fed chose to surprise even us.
Yes. I mean, we were looking for them to raise their 2024 and 2025 dot plots to, by 25 basis points, basically, and they raised them by double.
Yeah.
So, even more hawkish than we thought they would be, which surprised us. And that is why we took away cancelled our bid in the shy ETF, because we thought, wow, there's a chance that things go even worse. But they didn't. Let's talk about why they could. Why do you think they're that hawkish? Because even the Fed governors who came out and commented on the Fed minutes after the Fed minutes were hawkish. Slightly surprising that they're that hawkish. What do you think is going on?
Yeah, particularly in the context of a world that is less hawkish. BOJ, BOE straight out surprised the market by not hiking. SNB, the Swiss National Bank, all of those, and the ECB in the statement initially a week ago, all appear to be done. But the Fed is maybe done, though they left another hike on the table. But they were very clear about the pause. And that was unlike the other central banks that were less clear, the Fed decided to be quite clear. And I think so that was the idea of a damp spring report I wrote called The Two Steps about a month ago. And the idea was that the cuts that were priced in at one point in the year, 160 basis points of cuts in 2024 was priced, and even cuts in 2023 were priced. What that meant is that interest rates were low in the longer term, even from 2 years on out. And that's stimulative. And so what the Fed needed to do, and they clearly felt that they needed to do that, is aggressively push out any thought in the market that they're going to cut in the next, call it 9 months. And that's what they did.
Yes, I absolutely agree. I think their thinking goes along the same lines as ours, and that is that we are all afraid of the bigger danger. And the bigger danger is a reacceleration of inflation over the medium term. If they push back aggressively against expectations of cuts and keep real rates high, then that danger diminishes. I
See,
think they are much more inclined to sacrifice a couple of 100,000 jobs than they are to let inflation rip again in the near future or even in the medium term. So they want to err on the side of caution and keeping real rates and the market as close to the Fed funds rate as possible for as long as possible until it becomes absolutely obvious that inflation is not only going towards target, but is going to stay at target. And that means much longer. And that means that the supply that the Treasury is going to put out in the next few quarters, because this is not supply that is going to happen and then stop, but the supply is going to be continuous and increasing, is going to basically steepen the yield curve. And the long end, the duration is just not going to be bid anytime soon, not aggressively. So let's discuss what the implications of that are and what we think the bond market is going to do, and therefore how it's going to impact equities.
right. So let's start by saying what happened last week. Last week we saw on Thursday in particular, a very radical sell-off this is after the Fed, a pretty radical sell off in long term bonds, with yields taking out all of the highs from October of last year, with TLT, the most popular long term bond ETF, making a new low for the last, for a long time, actually. And stocks followed, though they behaved okay, they did follow. And, Russell is now down 10% in the last 2 months, and the S&P and Nasdaq are down over 5%, and last week was a pretty big sell-off. So that's what's happened. The implication to me of what Nick was talking about, which is a supply, so the Fed is going to push long-term short-term interest rates higher for longer, and was very aggressive in saying that. The global central banks seem less aggressive because their growth conditions relative to the US are weaker. In fact, most analysts, most economists, and to some extent us, are fairly bearish on the relative performance of the global economy, but at very low levels. So the potential for those things to turn on limited from where they are and support growth, not just in their own local economies, but around the globe and in our economy, means that you're going to have more upside risk to both growth and inflation. And on top of supply, that creates a triple whammy for bonds. And so ultimately, equities are a discounted cash flow, just like any other asset. And high long term bond yields are going to take the legs out of equities. And that's begun.
Yes, I absolutely agree. And I think that we are at the first stage of a multi-month trend, which will be lower multiples. The only thing that can support equities is much higher than expected earnings, and we're already pricing in very aggressive earnings for 2024, earnings growth for 2024. If the
Very.
market now starts taking those out, then the equity market will be in trouble. But that is not something that we have to worry about right now. Let's, having explained what happened last week and the implications, what do you think about next week? Very light week, right?
Yeah, I mean, the data is going to be of less importance because it's mostly secondary home sales, durable goods, things of that nature. We do get a lot of bond issuance, 134 billion bonds. What's notable about that is they are short term bonds, twos, fives, and sevens. But also, what's notable is over the past, so for one thing, every bond that's been auctioned lately is underwater. So that means every bond buyer has lost money at the auction. And more bonds are coming, and more bonds are coming behind that and behind that. And so there's this question about why rush to buy bonds right now, and we'll see some evidence of it as this $134 billion, which is quite a lot, come off. So I'm more concerned about the month end pressures and some technicals in the stock market that make me think that we're going to have a rough week in equities. Bonds, they've moved a lot, but an equity sort of 100 point, like 2.5% to 3% sell next week wouldn't surprise me in the least.
Yeah. And our macro outlook just isn't changing, is it? Maybe it's helpful to recap what we've been saying really from day one when we started in January. We've been saying that cash is at very attractive levels. And we've been saying that it's tough to see how equity markets can beat the return of cash over the medium term at this moment. And we've also been saying that duration is likely to be on sale, and therefore that's likely to increase the pressure on multiples and therefore increase the pressure on equities. What we got wrong is that we didn't anticipate, and we are never going to anticipate or be able to anticipate, because that's not our forte, the performance of the Magnificent Seven throughout this year. It's something that came out of left field and something that really we could not foresee or are ever going to be able to foresee. What is interesting is that despite the performance of the Magnificent Seven throughout 2023, where is the performance of the equal weight S&P? The equal weight S&P to date with dividends reinvested is up 2.7% year to date. And that is worse than cash. So we feel vindicated in what we've been saying, although our portfolio performance has not been beating the S&P, but that is not the point of this program and of this website. The point is to give you something to talk about with your investment advisor, or if you are doing this solo, independently, to give you a framework for thinking about assets and their relative attractiveness. We think that we've added value by doing what we've been saying since the first day, and I think that's being vindicated at the moment.
Right. It's important to say that if we were doing this program a year ago, the things that, or if we started in July of last year, those Magnificent Seven were the opposite of magnificent through December. And so, I don't feel guilty at all about missing the Magnificent Seven. I think we've had our minimum equity exposure. That said, we had we were fairly heavily invested in equities and got out near the top. And at the same time, we were fairly heavy invested in TLT and got out absolutely at the top yield. So our portfolio has been a defensive portfolio expecting assets to underperform cash, and they absolutely have. So that's why you're here. Hopefully that's providing value to you.
What do you think about gold and commodities? Is there anything interesting that we can say about those as diversifiers?
Yeah, I think our gold ranges from 5 to 10%. And I think gold is tough right now. We're at 7-ish%. And gold is tough right now because gold is really bond-like. It really looks like real yields with some optionality for the potential of, major currency events. So we like gold because it has that optionality that is fairly unique. Potentially crypto has it, we'll see. But we like having gold. So our minimum's 5 and our maximum's 10. We're not at our maximum because it's too much. We don't like bonds. And so
Yes.
I think that's where we are on gold.
I think gold is going to outperform bonds because there's less supply, but also gold has a certain amount of optionality in case the Fed does something wrong.
Right.
So it's going to outperform the bonds for the time being. But one of the things why I am not in favor of increasing gold allocations here is that from everything we've been saying, you can see that no central bank is ever going to manage to out-hawk the Fed. That has implications for the dollar is going to remain bid. And since gold is denominated in US dollars, I think it's going to perform much better against the euro or against the yen or against any other foreign currency but the US dollar. So if you're US dollar based like we are, it's very difficult to buy gold at this level and think that it's going to perform. It might outperform bonds, but it's not going to perform for us. If you are in a different currency, like the yen or the Chinese yuan, it's probably a great investment at the moment because the currency part of it is going to perform for you, not necessarily the gold itself.
Right. And I think that's right. So for those of you who are non US dollar based investors, I could imagine having a slightly higher allocation than we do in gold. In terms of commodities, commodities are a growth asset. And they also tend to protect. They're also an inflation asset, and they tend to protect you from, sorry, they do well when growth is higher and they do well when inflation is higher. So sometimes those things are at odds. And I think that certainly around the globe, growth expectations have fallen a lot, except in the US, to what I think are unsustainably low levels outside the US, and possibly a little bit too optimistic in the US. So for commodities, um, you would like to own commodities in a growth environment, and growth is broadly about right, varies from country to country. And you'd also like to own commodities in the case of a inflationary spike. So, given our macro outlook, we recognize the possibility that we have an inflationary spike, but we also recognize that commodities have principally performed because of their oil component in the last few months. They're up quite a bit in the last few months. They're the only asset that's done well. And our allocation is going to stay where it is because we consider it a diversifier less than a speculative play. From a speculative side, if we wanted to speculate, we probably would have been aggressively buying oil at low levels instead of chasing it here. And if we wanted to speculate the other direction, we'd reduce our commodities exposure to zero, given the very strong run up, particularly in oil. So that's not our game. Right now, we think commodities at our current allocation is about fair and principally for a diversifier. In other portfolios I manage, I happen to think which owns some other things, a little bit more broadly owns assets than we do. In particular, owns a bit more bonds. I could see adding commodities as a diversifier to your bonds to increase that. But given our allocation at Two Graybeards, I can't imagine why you need to have to change your commodity allocation at this stage. Better to, when we start to spend cash and start to buy bonds, better to look where commodities are at that point and then add both.
Yeah, I absolutely agree. So, what are we going to do to our allocations? We are very defensive. We have lots of cash. We have a little bit of very short duration bonds, and they're doing fine. We have a little bit of yielding 7.5% VWOB, which I think has performed so much better than TLT and has been such a diversifier for us. And I love it. I think it's going to continue to just print money quarter after quarter at 7.30%. I mean, how bad can it be? So what can we do to add value to where we are?
Well, I guess pardon me, I have a cold that I'm getting over. Part of the most important thing that I would take for this coming week is that bonds have moved a lot, and it's going to take a lot of data, which we don't really have. It's just going to take supply, which we have, to move them, and so that they may slow down their decline, but are trending lower. So that seems clear that is an opportunity, particularly if volatility and level come in play. So I'd like to think about sort of more for a 1 month sort of outlook, find a level in which we can sell puts. However, S&P, as I said, I think we're going to be down 3% because of a variety of month end and very options technicals, plus a deleveraging that seems to be catching up on equities. And so for me, I think we're going to sell off. So I would be interested in buying on that significant sell off as a trade. How do you think we should structure things like that?
Well, I think I'll cover it in more detail in my little segment, but I think we have a variety of technicals indicating that we're going to go below 4,200 in the S&Ps, and that the 88, 89 level in TLT are very important, and that even if we get there, we bounce for sure. So yes, I agree. Selling some puts at levels, and I'll put that into the Excel file, the exact orders I'm going to put in, and cover it in a moment in my little segment.
Great. I think this was an exciting period of time the last couple of months as we've been on the defensive side during periods of quite a bit of optimism for both bonds and stocks. This is what we were expecting. hopefully we are helpful, and we will see you next week.
Absolutely. See you next week. Let's review where we are. We've been slightly hemorrhaging money because we still have allocations to both stocks and bonds, but they are losing far less than the market, and therefore we are happy. That's all we can say about that. As far as orders for next week, here we are what we intend to do. We are going to sell SPY only 1 week puts, and only if it gets to 175, because we think that the early part of the week could be ugly. And we're going to sell TLT 1 month puts at 88. These two levels, 419 in the SPY and 88 in TLT, are what we consider to be short-term value, and we are quite happy to buy them at those levels. And we are also quite happy to buy calls should the market get there. So if you are not into option selling, or you can't do it, or you just don't want to, basically these are levels where we are prepared to buy the market. So in any case, whether you follow these orders or you just wait for the market to get to those levels, you should know that those levels are what we consider value in the short term, and where we think we can see a 3, 4, 5% bounce from those levels. Thank you very much indeed, and have a lovely weekend.